Hello and welcome back to Dukascopy TV. Now, William Shakespeare once said, "All that glistens is not gold." Well, gold is glistening and it's in the spotlight this week after extending its bull run thanks mostly to a growing lack of confidence in major global currencies among central banks and investors. And of course, news that more QE is possibly on the way from the Fed in mid-September. Well, joining me on the line now is Grubb from the World Gold Council, the foremost authority on gold. Thanks for taking the time out to speak to us, Marcus. Let me first start by asking you bluntly, what's so great about gold and gold in a market environment?
Well, gold has a unique history going back 5,000–6,000 years as both a jewellery metal, perhaps the premier jewellery metal on Earth, and also as an investment product for that long, and currency. I think that's the first thing to say about gold. Its heritage is unequalled really by any other currency or luxury item. I think the second thing to say is that from an investment perspective, gold has some quite unique properties. It's always had them throughout history. It's been a store of wealth and value. It's been a diversifier, a hedge against risk, like an insurance policy in terms of your household wealth, your pension, or for institutions in their portfolios. And I think in more modern times, that's exactly the role that gold has fulfilled as an investment asset. So I think those are the longer-term facets of gold from both a jewellery and an investment perspective.
Now, many analysts are pointing to further QE from the Fed in mid-September. Just briefly talk us through what this means for gold and how is this gold rush, if you like, in the markets affecting major currencies?
Yes, we're in the 11th year of a gold bull market, and possibly by the end of this year it'll be 12 years in a row that gold has ended up on the year. And as you rightly point out, that has been a period where we've seen more latterly, in the last 5 years or so, a big expansion of central bank balance sheets as they have taken on bad assets from the banking sector, bailed out sovereigns in Europe, and accumulated other liabilities onto the sovereign balance sheet in order to maintain economic growth, prevent a deep recession or depression, and to pump prime the economy. Right again, in that they are currently entering a new round of that form of stimulus, which, as you say, is called quantitative easing. And yesterday, the FOMC minutes were released, which suggested that the Federal Reserve in the United States is perhaps adopting a more dovish attitude again. And either at the Humphrey Hawkins testimony at the end of this month or the FOMC meeting in September, we may see more stimulus in the United States because the economy, although it's recovering, it remains a sluggish recovery. And therefore, gold is currently heading up significantly. It was only a couple of weeks ago, it was below 1,600. We're now at 1,665 and continuing to rise. So I do think currently the market is starting to price in expectations that more policy easing is required and it will happen in September. And of course, on the European side too, it's clear that something has to give within the Eurozone. There needs to be stimulus because a number of economies are in a very poor state. And the decision on what to do with Greece is imminent. They have failed to meet their targets. So either Greece defaults or the restrictions and the targets around Greece's bailout have to be eased in order for Greece to continue to comply and continue to implement austerity to try and stay within the euro.
Now, according to the World Gold Council, central banks are expected to buy up a total of close to 500 tons of gold this year. Is this a sign world currencies really are depreciating and will continue to do so for the foreseeable future?
I think it's a sign that central banks do see themselves, emerging countries in particular, A, as underweight gold, and therefore they're seeking to raise their weightings to more international average levels for central banks, and B, that they're underweight gold compared with fiat currencies, in particular the US dollar and the euro as the two largest currencies in the world. And so they are effectively diversifying away from those currencies by purchasing more gold. And as you say, we are likely to have a record year this year for gold purchasing by central banks since the early 1960s. It currently stands at 250 tons at the half year, and we expect the same amount in the second half, so 500 tons for the full year. I do think investors should be paying attention and asking themselves why, at this point in the economic and financial cycle, central banks that are effectively in countries with surplus and with a low level of debt are buying so much gold.
Finally, if gold keeps rising in price, its value will eventually drop. Is this likely to happen in the long run?
Well, I think the gold price is currently, once again, in an upward trajectory. I think the fundamental underpinnings for the market are very strong. although many people look at gold and the gold price as being driven really by macroeconomics, inflation, central banks, interest rates. It's also true that it is driven by fundamental demand and supply, just like any other natural resource. And if you compare gold to other metals and commodities, it's a very interesting study because mine production over 10 years is virtually flat. So the only way you've been able to meet this increase in gold demand over the last 11 years is through recycling predominantly jewelry into investment products. And that's effectively what's happened over 11 years of this bull market. So at this rate, it's quite possible that we'll see that process continue if investment demand increases again because of all of these factors, the central banks and also fear about the Eurozone and concerns about the US economy. We think that's unlikely and that you're actually going to see demand and supply keep pace with the price because recycling will increase, even if mine production remains very flat. The final point of the puzzle is, of course, with flat mine production, it means this is a metal in deficit, not in surplus, and mine producers are struggling to meet the demand.
Well, that's all we've got time for today. Thanks very much for joining me, Marcus, on what is clearly an interesting time for gold. I'll be back tomorrow with further interviews and updates, but until then, goodbye.